Hello and welcome back to The Note, and welcome also to our glorious new state-of-the-art studios in our offices in downtown Manhattan. You'll be seeing a lot more video from these studios in the months to come. For now, the topic of the day is catastrophes, hopefully of the natural rather than the financial kind. There is a boom in catastrophe bonds, bonds issued ultimately by insurers which pay you a very good yield unless there's a catastrophe. Should we be worried about this trend? With me now to discuss this is my fellow Financial Times columnist, Gillian Tett. Gillian, thanks very much for joining me. Let's start by taking a look at the trend in issuance of cat bonds, as they're known. It's really quite startling. It's obvious Wall Street's worked out how to sell these things. What do you think is driving this? What's going on?
Well, what's driving it really is the same thing that's driving so many asset classes at the moment, which is the desperate search for yield.
Right.
You've got a lot of pension funds, a lot of institutional investors sitting on money, and they're looking for somewhere to put their cash that will produce a bit more than fixed income products elsewhere, but also they're very much looking for something that's uncorrelated. Because of course one of the stories of the last few years is that so many asset classes started to move in tandem with great correlation. And so banks have been telling clients, well, buy catastrophe bonds because actually the chance of, say, a hurricane hitting Florida is uncorrelated to the stock market in theory.
Now that's interesting, because if we take a look at the actual history of catastrophe losses that US insurers have suffered, you get this big spike because of Katrina, but apart from that it's not obvious that there's any decline over time in catastrophe losses.
Well, absolutely. I mean, what's clear from the chart is that catastrophes have not gone away, but interestingly enough, the yield on catastrophe bonds has fallen quite sharply, which essentially suggests that investors are not being compensated for the same level of risk as they've always had.
Okay, and we could look at that another way in terms of, rather than looking at the yield, if we look at the total return these things have generated, it's really quite startling how they continue to go up like a rocket. Now, I wrote about this industry many moons ago when they were trying to get it started, and Warren Buffett at one point bought an entire issue of cat bonds because he reckoned they'd got the price right. What are canny people like Warren Buffett thinking now?
Well, what's interesting is that Warren Buffett has got out. I mean, he's never been that big in catastrophe bonds, but these days he's not even writing reinsurance because he thinks that actually the insurers, i.e. people who are holding the bonds or providing insurance in other ways, are just not being compensated anymore for the level of risk that they're running.
So that inclines me to think that if we're not necessarily going to have a financial catastrophe out of this, we are setting ourselves up for a classic bust following a boom.
Well, like so many parts of the financial world today, there is so much money swirling around the system because of quantitative easing that essentially investors are taking on bigger and bigger risks without getting the same level of reward. And the reality is that if, heavens forbid, a big catastrophe does hit, if we have, say, a hurricane in Florida, an earthquake in California, a lot of investors will find they're carrying losses that actually they hadn't really expected to bear, and which aren't in the price.
Okay, Gillian, thank you very much indeed. I think the message is reasonably clear. Many times in the last 10 years, people have piled into investments because they are not correlated to what they already have. When you do that, they tend ultimately to become more correlated. Whether we're heading for a catastrophe is another matter, but this is a plainly worrying development.